Good morning, ladies and gentlemen. It is my great pleasure to be here with you at the 93rd IREPAS meeting in Munich. First of all, let me extend my sincere thanks to SteelOrbis and IREPAS for this invitation. Before I begin, let me clarify something very important. What I will share with you today reflects only my own independent research and personal views. These views do not represent the official positions of any company, institution, or association I have been affiliated with. I take full responsibility for the accuracy of the data, and any error or omissions are my alone. Okay. Today, my talk will cover three broad themes: China's economy and steel market in transition. The transformation of China's economic structure is driving adjustment in both the demand structure and product mix of Chinese steel industry. Second, global trade shifts and the impact of Trump tariff 2.0. So how changes in global trade environment have affected global trade and China steel trade. Third, the medium to long-term outlook for global and Chinese steel demand. I'd like to share a forward-looking perspective supported by research into long-term demand models. So let us begin with China. As we all know, China has been the world's largest steel producer and consumer for more than 2 decades. Its sheer scale has influenced global balances, price trends, and investment decisions across the world. But the era of rapid growth is now firmly behind us. China's steel demand peaked in 2020 and has declined for 4 consecutive years. Real estate was once the single largest downstream driver of China's steel industry. But following the introduction of the 3 red line policy in 2020, the property sector entered a sharp downturn. New construction starts are now down 74% from their peak, falling by about 20% annually, which has significantly reduced demand for long products like rebar. Infrastructure investment growth has provided some cushion, but it cannot fully offset the property slump. For decades, houses and highways were the backbones of China's steel demand, and this chapter is now closing. But the good news is that another chapter is opening. The rapid upgrading of China's manufacturing industry is driving growth in flat steel demand. The shift in export products is the clearest evidence of this transformation. From labor-intensive goods such as textiles and toys to high-value products like electronics and machinery, and now to new energy products such as EVs, solar panels. Exports of electrical passenger vehicles has increased nearly 13-fold between 2019 and 2012, and are still growing at nearly 50% this year. Shipbuilding, machinery, and household appliances are also contributing to this shift. So this has 2 implications. First, steel demand is moving from construction toward manufacturing in China. According to CISA, China Iron Steel Association, the share of steel used in construction has been declining by 2 percentage points each year since 2020. Last year, for the first time, construction and manufacturing accounted for equal shares of steel demand. Second, product mix is shifting from long products to flat products. The share of flat products in steel output has risen to 63%, far exceeding that of long products. And in the first 8 months of 2012, China's crude steel output dropped by nearly 20 million tons, or 2.8% year-on-year. Yet manufacturing resilience has prevented a steeper fall, even under the pressure of Trump tariffs. Meanwhile, China is pressing hard with its green transition. Over 80% of its steel capacity has completed ultra-low emission retrofitting. And AI and digitalization are also helping to cut costs and raise efficiency. But still, Chinese steel industry must keep adapting to a shrinking of long product market by adjusting its product structure. Now let us look outward. Steel trade is vital to steel industry, with direct and indirect exports together accounting for over 40% of global production. But trade flows are changing. Direct exports peaked in 2016, falling from 31% to 25% of global output last year. By contrast, indirect exports through downstream products like autos, machineries, and ships continue to rise, now accounting for more than 1/5 of total steel output, almost equaling direct exports. This reflects a broader shift in world economy. As tariffs and trade barriers rise, more steel moves across borders in manufactured goods rather than as steel products. So for exporters, this is both a challenge and an opportunity. Since 2001, non-Chinese steel exports have fallen by 60 million tons, largely due to the Russian-Ukraine conflict. This large shortfall in global steel exports is also the reason why global steel market prices rose sharply to historically high levels after 2021. And China's and Southeast Asian suppliers have stepped in to fill much of this gap. And meanwhile, they also have taken market share from some traditional exporting countries. The growth in China's steel billets exports follows basically the same pattern as the increase in its steel exports, and together with the rise in Southeast Asian exports, has helped fill the void created by Russian-Ukraine conflict. According to my calculation, emerging markets I have calculated based on the steel production outside of developed countries, or CIS countries, and China, and Japan, and South Korea. So emerging markets have seen supply and demand grow at roughly 4% over the past 40 years. And part of that increase in demand has been met by additional exports from China. However, due to the recent rapid increase in anti-dumping and safeguard cases against the Chinese hot-rolled and cold-rolled steel products, exports of both these products have decreased this year compared to last year. But at the same time, exports of higher-end coated and pre-painted steel, as well as billets, long products, and pipes, have increased. While the increase in China's export of long steel products, which is a major concern for all the attendees today, continues, a key characteristic in this high proportion characteristic is the high proportion of intra-regional trade. Over 70% of China's long steel products, represented by rebar, are exported to countries within Asia, with less than 30% exported out of Asia. In addition to trade remedy measures, China is also facing the pressure of Trump tariff war. It was widely expected that China's exports would be hit hard and decline sharply, but they have continued to grow at a relatively rapid pace. China's overall exports remain resilient until now, thanks in large part to the efficient Chinese steel sector, which underpins the global competitiveness of Chinese manufacturing industry. Of course, Trump tariff affects not only China, but all countries. This raises the key question: will global steel demand continue to weaken, and for how long? History offers an answer. My research into the past century shows that even in the worst crisis, the Great Depression, World War II, global financial crisis, global steel has never declined for more than 3 consecutive years. Each time, recovery followed quickly. So while Trump tariffs is creating short-term turbulence, the long-term growth trajectory of global steel demand will remain on course, I think. Finally, let me share the result of my long-term forecast research. To forecast steel demand over several decades, I conducted a year-long study of steel consumption history and economic development of major developed countries. I have also reviewed all of the existing forecast methodologies. Among these, the S-curve model, which suggests an S-shaped relationship between per capita GDP and per capita steel demand, has been particularly influential. However, this model has limitations. Early versions predicted that China would peak in steel demand around 2014 to 2016. Yet demand continued to grow until 2020. So this called for improvement in this methodology. In this research, I made 4 methodological improvements. First, I replaced crude steel with finished steel demand to more accurately reflect real end use. As steel-making yield rates improve over time, crude steel overstates consumption growth. For instance, in Japan, yield rose from around 75% in the 1950s to 95% by 1990s. Using finished steel gives us a cleaner signal. Second, I standardized the GDP figures using the latest GK dollars instead of 1990 GK dollars to ensure better economic comparability across countries and time period. Thirdly, I consolidated all the data sources, primarily using consistent, continuous data sets, such as those from World Steel Association and Japan Iron Steel Federation, reducing inconsistencies from mixed and outdated records. Finally, I've taken into account of the effect of indirect trade, thereby broadening the scope of the assessment to fully capture the comprehensive impact of steel trade on demand. So after implementing the above-mentioned improvement to the S-curve, we no longer see a simple S-curve in the graph at the bottom right here. When we break it down, it becomes clear that the S-curve model doesn't apply universally. We've got countries where per capita steel consumption keep climbing as GDP grows, others that hold on to high consumption levels even after hitting their peak, and still others that stay low across the board. Countries that quickly industrialized, like Japan and South Korea, experienced higher peaks in per capita steel consumption compared to those that industrialized earlier. Nations such as Germany has kept have kept their steel consumption high thanks to their strong manufacturing sectors. That was before COVID and Russian-Ukraine war. In contrast, the US has seen a significant drop in steel consumption, driven by outsourcing and a pivot towards service industries, a trend not seen in Germany, where robust manufacturing has continued to cushion the decline. So my first finding is that not all countries follow the traditional S-curve in their steel demand development. So the next question is, which pattern will China follow in the future? After careful analysis, my prediction is that China will most likely to follow a path similar to Germany's. Given our limited time today, I won't elaborate the reasons why I believe China will likely follow a path similar to Germany's. For those who are interested in this prediction, please refer to my report published in Iron Steel Technology at AIST in June of this year. The download link for the report and its main content are included in today's material. Currently, all long-term forecasts of China's steel demand show a linear decline. Sorry, I have to switch back a little bit. And the question is, will China steel demand continue to decline indefinitely? I have studied the steel consumption history of all developed countries. None of these countries experience a linear decline in demand. Instead, they all show rebounds and fluctuations. We can see these points from two graphs from Japan and Germany. So the next question is, how deep will this decline be? According to my research, structural changes in the economy have a strong influence on the magnitude of the post-big peak design. Due to differences in economic structure and industrial policy orientations, the magnitude of the decline varies greatly among different countries. The final point of my findings is that per capita steel demand rebounds by more than 40% after 8 to 9 years of decline in many countries. Factors like economic cycle and structural shift can trigger rebounds in steel consumption. So the four above-mentioned findings lay the groundwork for my forecast on steel demand in China and worldwide. Looking ahead, we are at a historical turning point. The world is shifting from decades of globalization to a more fragmented, deglobalizing environment. Forecasting steel demand now requires us to account not only for population, urbanization, and rising incomes, but also for geopolitics, supply chain realignment, and global green transition. Massive investments in renewable energy, electrification, and infrastructure will create new sources of steel demand, as mentioned by several speakers this morning. At the same time, advances in AI and digital technologies will accelerate this transition. Based on this research, I project global steel demand will grow steadily at an average annual rate of 1.1%, reaching 2.3 billion tons by 2050. China's story is more complex. Demand has already peaked and will gradually decline. But this is not a collapse, but a moderately decline. China will not hollow out its manufacturing base. Instead, as I mentioned, it will resemble Germany's model, maintaining relatively high per capita steel consumption through a strong globally integrated manufacturing sector. So the product mix of Chinese steel industry will continue shifting towards flat and high-end steels. So, ladies and gentlemen, oops, sorry, here it is. Here's a quick recap of what I've covered today. Due to time constraint, I'm not reading it again. But finally, I'd like to leave you with 3 key takeaways here. Firstly, have confidence in the future of global steel demand. Difficulties are temporary, but growth is enduring. Except in times of global war, pandemic, and financial crisis, history shows steel demand rarely falls for more than 3 years. The industry, as a grain of industrial production, still have ample room to grow. Secondly, recognize the resilience of Chinese steel demand. Although demand has peaked, it will decline only slowly. China's competitive manufacturing base ensures steel demand will remain substantial for decades to come. Thirdly, every country's steel company, I think, must improve efficiency. Trade protectionism can shelter the steel industry temporarily, but it weakens downstream industries, and ultimately, we reduce domestic demands. Long-term competitiveness depends on productivity and innovation. So thank you very much for your attention, and I look forward for the discussion later.